Well, welcome everybody, and thank you for joining us today for our webinar with our property market outlook, and particularly focused on expats and overseas buyers and looking at international money transfers. I'd like to welcome Natasha Brown from OFX. Thanks, Natasha, for joining us today, and it's great to have you on board. And we will also be going back to a Q&A session. So at the end of our presentations, which we will try to keep as succinct as possible, please just put your questions in the Q&A or the chat box, and we will get to as many questions as possible. We love questions. I know I do, Natasha, and answer every single one as much as we can. So please put your comments in there as we go through. Now, I'm going to share my screen so we can work out number 2. There it is there, and get going. So today, I'd like to talk about where we're at with the Australian property market, and there's a couple of things that we'll be looking at, particularly around the market and particularly around migration, which has got a big factor to play going forward in the property market. I'll also be talking about borrowing capacity, particularly in the face of higher interest rates, and how you can really take advantage of those higher rates as well. And then look about some property strategies that you can take advantage of to get the maximum advantage you can. And as I said, we'll also look at Q&A as we go forward. So that's a great packed agenda. Quick 30 seconds on myself. I've been in business actually 22 years this year. I need to update that. We've won over 40 awards for excellence, my team. Our company works as exclusive buyer advocates. We don't sell property. We purely work on the buy side. And I've been the president of the Buyers Agent Association of Australia for 4 years as well. Now, let's get into the market. Everyone's got an opinion, right? I can't see everybody's hands raised or smiles or smirks or anything on the screen, but everyone's got an opinion on which way the market is going. So I'm going to give you my perspective, which is a really interesting one because I get to see what's happening on the ground through my entire team of buying agents right across the country. But I also get to talk to some pretty high-profile people like Tim Lawless, who's the head of CORELOGIC, and some of the top economists. I was actually invited into the boardroom late December, into the boardroom of UBS Economics, and had a really interesting round table with some of their senior economists about where the market's going next year. So I'll share some of that later. So where do I think it's going? Well, the good news is, and so there's a bit of good news and a bit of bad news to share with you. The Consumer Sentiment Index, which measures where consumers think things are going to go and how they're feeling about the economy and feeling about spending money, has started to tick up. You can start to see here on this bottom part of the screen where it's probably at about 86 points now. So obviously during COVID, it got down to its lowest ever point, down to around 76 points. But it's now starting to climb because people feel like, inflation's starting to pretty much taper off, or starting to really be at its peak. We're heading to the terminal cash rate. So there's a bit of positivity out there. I think the cash rate, if you ask me where I think it's going, I think we'll probably see it terminate at around 3.6 or maybe 3.85. So I think we've got between 1 to 3 interest rate rises left to go. Definitely one next Tuesday, and probably another one in March, and then there'll be a pause from that point forward. I think if we get to a cash rate over 4%, there'll be really severe mortgage pain. So it's just going to depend on how quickly and how fast inflation comes down from its peak, which is anyone's guess at this stage. But the good signs are that it is coming down. Now, let's talk about the market. Where's the property market at? Well, obviously, we're in a correctional phase. So these are the latest figures now here from Domain Price Guide or Domain Price House Report. So these are the figures for houses across the capital city. So you can see Sydney's median house price is now back to 1.4 million. Melbourne's down to just over 1 million. Brisbane 800, Adelaide 783, Canberra 1,095,000, Perth 658, and Hobart 737. But year on year, you can see that Sydney's down 11%, Melbourne's down just under 6%. Brisbane's just started its correctional phase. Adelaide's still up. It's still kicking some goals, but I don't think it'll last that much longer. And then Perth and Hobart are also up. So really mixed bag of results right across the country. We look at apartments. This is the units for rates for apartments. You can see Sydney's median apartment price is 748,000. Melbourne 561,000, Brisbane 444, Adelaide 422, Canberra 567. And again, a mixed bag of results, generally trending down. You tend to see a across the board decrease for most apartments across the country. So let's have a look at the index that CoreLogic put up. This is the rolling 28-day daily home value index. This gives you a bit of a trend as to where, and this is an average figure, by the way, so it hides a lot of things, but it does give you an indication of where the market's at. So back in July, it was dropping at around 1.5%, but you can see that the rate of decline started to slow and then it picked up again, and now it's starting to slow again. I think the rate of decline will probably sit at around 1.5% for the next couple of months, particularly while we go through the rest of this interest rate adjustment upwards to the peak interest rate for this cycle. So I think interest rates will probably, as I say, peak around that 3.6 to 3.8% mark. And then we may even see a rate cut very late this year or early next year to re-stimulate the economy. Hopefully the Reserve Bank won't leave it too long to pull the trigger on that. Now, if you're out there looking to buy a property and you're wondering, why can't I find anything or why there isn't much stock, it's pretty simple. The listing volumes are significantly down. Now, the previous 5-year average is this dotted line, this dotted black line here. And you can see that the red line is the 2022 levels. And compared to the 5-year average, we're 22% down on the 5-year average, or down 25% compared to this time last year. So people aren't listing as many properties for sale. So the volume is limited. So that's for new listings. And a pretty similar story for total listings. So this is the number of actual total listings that's new and old, so existing listings in the market. And look at the 5-year average, it's down 29.5%. So very significant level there. So that's why the market is still tight. Now, if the market was flooded with listings, you'd see a much greater drop in prices as well. So this lack of listings is also helping to stabilise the market. So my summary outlook for the market going forward is simply this, that the rate of price decline will slow. I think the next 6 months will bring some of the best buying opportunities available in the current cycle. Rates are going to peak. Borrowing capacity is definitely reduced. We're seeing the psychology of buyers is that they're very confused. They're actually quite cautious, or they're very uncertain about which way to turn. So I think there's a lot of scope to help buyers this year to make better decisions with their property, the property market. Now, the big factor, which I'll talk about in a minute, is migration. The migration wave that's coming. That is absolutely going to turn around this property market. It is the number one X factor that will start to see price rises by the end of this year. And we're also going to see a massive increase in rents again this year. We had around a 10% increase in rents across the board last year, and we will see it again this year. But the key thing to note, guys, also is that housing prices generally are still around 20 to 25% above what they were at the beginning or mid-2020. So we haven't had all of the losses wipe out the gains that we had during the COVID period. And I think people have got short memories in that. So that's one big factor to consider. So let's talk about migration. Obviously, Australia is built on migration. We have a wonderful multicultural society, and it's a really important building block for our country. So if we look at the numbers here, there's the significant, obviously, drop off in migration over that COVID period. You can see the huge dip there, where we basically had, negative migration and zero numbers arriving on our shores. Now, the government increased the cap from 160,000 to 195,000 migrants for the current financial year. I still think that is too low. I think they really need to ramp it up to around 250,000. So the 195,000 includes permanent migrants, but again, on top of that, you can add all of the temporary visa holders and student visa holders that need to come. So I think that the numbers will probably be greater than what is anticipated. And a quick sort of walk back down history lane, I thought I'd throw this graph from the ABS, and it just shows the level of migration since the turn of the century. So you can see there, World War I, we obviously had a massive drop off and then a big recovery. Post-war migration was very significant in rebuilding Australia. But then have a look, since about the year 2000, dramatic increase in migration, and sort of between 2005 to sort of the current day, we were averaging around 200 to 250,000 migrants a year. So that's been the sort of the level at which we've been encouraging new migrants to come. Now, how does that impact the property market? Very significantly. Every one of those migrants needs to rent a property. They typically rent for 1 or 2 years before they buy, but they need a roof over their heads. And I think we're going to have a massive shortage of properties in the next 2 to 3 years. So that bodes well for investors, but it doesn't bode well if you're a renter. So talking of rents, as I said, are going to continue to rise. It's definitely on the cards, and let's look at the figures from CORELOGIC. Last year, the annual change was 10.2%. The individual rates, look at Brisbane, 13.4%, Adelaide 12.9%, Sydney 11.4%. So if you're a landlord and you haven't reviewed your rent, you'd be crazy not to talk to your property manager and see what level of rent increase you can achieve. If you're a renter, you'd be wanting to lock in to certainly a longer term lease, so you're not suffering a whole bunch of short-term rental increases. But I don't see that issue going away, because I haven't put the vacancy figures in there. Actually, I might have that later on, actually, but the vacancy rates are very low across every capital city, significantly low. The other issue to talk about is building approvals. So again, if you look at the decade average for houses and units here, you can see that this light blue, purple dotted line for houses there, we're starting to drop right off. And also for units, we're starting to drop right off. So construction costs have gone up astronomically, 30, 40%, even 50% in some areas. I'm doing a reno at the moment and it's costing a bomb, hard to get trades. So that's going to be an issue going forward the next couple of years, is if we're not building enough properties for all of our population and our migrants, then naturally property prices will start to rise again. Looking at lending trends as well, we can see here the value of lending is starting to drop off. So it's another indicator of where the market is at, that we're not lending out as much money to both owner-occupiers and investors. And that's just a natural consequence of higher rates going forward. So as I mentioned, how do we respond to this? Do we bang our head against the wall and go, hey, I've got to pay higher interest rates? Or do we go, how do I take advantage of this situation? So this is what I call the buy now or later dilemma. If you kind of wait for this perfect opportunity to get into the market, you'll find that your borrowing capacity will be reduced. And it already has been reduced. But you're also finding that prices are correcting. So yes, prices are getting cheaper, but you probably find that your borrowing capacity is declining at a much faster rate than what the prices are correcting in the market. So in actual fact, you're still going to be locked out of the market simply because you can't borrow enough to get into the market. So just be aware of that dilemma as you make your own property decisions. So since April last year, across the board, you'll find borrowing capacity is basically reduced 25%. So that's quite a dramatic drop off. And I'm sure a lot of you out there will be nodding your head going, yep, that's me, I couldn't borrow as much. And borrowing capacity, I've got to say, it's one of the golden eggs you've got to hang on to. If you can borrow money and leverage it into property safely, use it, because next year your income may not be as good. So if you've got borrowing capacity, I would say to you, don't let it expire. Definitely look at taking advantage of it. Yeah, these are the figures from PropTrack, and they show you just how dramatically, every interest rate that goes up, dramatically reduces your borrowing capacity. So let's talk about investors returning to the market. Why are investors coming back into the market? Look, we're finding good demand for our services as buyers agents from investors that need help finding the right opportunity, to find the right locations and the right property types that's going to deliver two things: capital growth and yield. And as I've mentioned, yields are definitely increasing. I've increased the rents on all my properties. Just the other day, I was able to increase the property in Melbourne that I've got from around $900 a week to $1,050 a week, so $150 a week. Another property I've got, I've just increased it $120 a week. So fantastic increases, but it still won't cover the interest rate increases that I've also got to pay on those properties. But you should be putting up your rents if you can. But yeah, also this lack of competition. That's the other thing. You know, a lot of investors think, I'll just wait till the end of the year. I tell you, one of the big advantages of buying now while interest rates are going up is you've got much less competition. There's still competition out there, but you've got less competition. Just think back to the boom times. I remember there's 40, 50 people lined up outside the property trying to get in. It was crazy. So I don't think we're going to quite get back to there in the next couple of years, but there will be more competition, hand on heart, absolutely. So what can you do if you're going to be buying a property? These are the 7 steps that you're going to need to take yourself, either individually or if you work alongside a buying advocate. First thing you've got to do is work out your strategy, work out what to buy, where to buy, what kind of strategy is going to get you to your endpoint. Is it something you want to renovate? Is it something you want high capital growth? Are you looking for high yield or a good combination of both? Then you've got to identify the locations where that particular strategy will work and deliver you the outcome you want. Then you've got to start the actual searching, getting online, talking to agents, compiling shortlists, going to inspections, taking notes, keeping track of the auction market and the private treaty market. Then you've got to decide which property shall I buy, which one actually stacks up and how much should I pay for it? That's a really difficult question for a lot of people. What's this property worth and how much should I pay? Am I overpaying? Am I underpaying? Am I getting a bargain or am I paying too much? So that's, you've got to do a really detailed analysis of the market. Then you've got to complete your due diligence, get your pest and building reports done, or a strata if it's an apartment, negotiate with the agent or the owner, get it exchanged, get the contract reviewed, and then the last step is going to the settlement and getting your property manager in place. So as buyers advocates, we do all of those steps for you. We take all of the pain out of that whole process, and most people on their own take around 12 to 18 months to actually complete that process. Our average turnaround time is around 30 to 50 days. So we're much more efficient and we're very skilled at getting the lowest possible price, getting access to off-market properties, giving you really great local knowledge and insights into local areas, and essentially giving you a greater level of confidence to go forward with the whole buying process. And that's what it comes down to. It's just making sure you make good decisions. I always say to my team, and this is our motto, is that people don't care how much you know until they know how much you care. And that's what we base our philosophy on. In terms of our fees, we work on a fixed fee basis. Essentially, it's between, for each price point, we have a fixed fee, which ranges between 1.5% to 2%, but we can email that to you if of interest to you. And your engagement fee ranges between $3,500 to $5,000, depending on your price point. But for that sort of money, you'll be getting a personalised buying advocate working alongside you every step of the way, giving you the research, negotiating, and saving you a lot of time and stress as well. So the other question is, why would you even consider buying now? Isn't this a crazy time to buy? Well, as I said, no, the market's leveling off. Vendors, I'm getting texts and emails every day, price readjustment. And it's amazing how many agents are now calling me back. Rich, can you get a buyer here? Can you do this? So we are definitely in that sort of much more negotiable phase of the property market. But the majority of buyers are just going to sit on their hands and wait. That's probably what 90% of the population do. Rather than being smart, which is jumping in when you can afford to jump in and buying really, really well. So as I said, financing costs are going to cost you more, but in the long term, it'll more than pay for itself simply by increasing rents and increasing capital growth as well. All right, so let's have a look at some case studies. I hope you're actually writing some questions down. I can't see them because I'm on my presentation screen, but I hope you're writing down lots of questions and I'd love to answer them. Now, I'm just going to give you a couple of examples of what we've bought for past clients. And I won't go through every one of them because, Natasha, I want to give you plenty of time for your part of the presentation. But I'll probably do another 3 minutes and then 5 minutes and then I'll hand over to you. So this is a property we bought for a client in Melbourne back in 2007. paid $580, and it's now being valued at 1.6. So simply a good buy and hold, 3-bedroom townhouse in Carlton, and they've made a really nice gain. So that's a pretty straightforward, simple strategy. Buy in a quality blue chip location, make sure it doesn't have a major vacancy, and hold on for the long term, and it's done very well. We can also buy a good combination of higher yield and high growth properties. So these tend to be found more in the Brisbane market. We bought this property last year. We managed to get it for $895, which was $40,000 below another offer. And that's simply because we had a good relationship with the agent and had better terms. We were able to close the deal faster, which was very important to this particular owner. So sometimes it's not about price, it can be about terms. Now, we actually managed to get $1,020 a week. So we got a gross yield of almost 6% on this particular house. So really good buy. We can also go for much higher yield properties. So this was a 2-bedroom, 2-bath apartment on the Gold Coast. And again, the estimated yield was 11%, but we managed to get 13.9% yield. So incredibly good return for a holiday let. You've just got to watch, obviously, all the expenses, but even after expenses, it still came in with a really good net yield. Another strategy that we highly recommend is considering granny flats. So either having a granny flat built on the back or an existing granny flat. So for this client, there was actually a granny flat at the rear of the property, and the combined rent for the house and the flat is $1,690, and it now value is at $2.4 million. So getting 2 incomes from one property is a great way to go. I'm actually building a granny flat as we speak at the moment, and using that strategy again, because I really like it, and it's a great sell to either another family or an investor down the track, but I'm going to hang on to it. Also duplexes. A lot of the properties we buy are duplexes, but this is one where we've got 2 side by side, and again, managed to get a great yield on this one of 5.67%, purchase price $770, and that was in the Brisbane market. Got heaps more examples, some in Sydney here for an owner-occupier in the eastern suburbs. We saved him 25 grand. I'm going to flick through Winston Hills District. I just want to get to one we bought for our expat client, if I can find it. I hope it's in here. Oh, actually, it's in the other presentation, but we also do commercial buying. We just settled on this one the other week, actually. This was a valuation came in at $5.5 million, but we got it for $5 million. So we managed to save our client $500,000. And industrial property, I've got to tell you, is in very hot demand, very difficult to buy compared to the office or retail market, which is much more subdued. So that's what we also do. And we get a lot of these properties off market. Again, for this particular client, this was a freehold asset. We had a 3+3 year term, and got them a great saving as well. So Natasha, I'm going to hand over to you. There's my details. I'll put that on the slides as well. So I'll just unshare. And Natasha, hand over to you to tell us more about OFX, and if someone's located overseas or looking to buy a property and transfer money back here, tell us all about that, please.
Yeah, no worries. Thanks, Rich, and great presentation. Thanks for giving us a bit of insight on sort of that macro view of what's happening in Australia in the property market. There are a couple of things I'll touch on that will actually hopefully relate to the audience in terms of what you've shared and how that actually flows through from an FX perspective as well. So let me just share my screen. Okay. Okay, so firstly, everyone, I'm Natasha, I'm from OFX. I work in our enterprise sales and partnerships team, really focused on working with partners to help them find the right FX strategies to meet their goals and objectives. I work across a number of industries. I have worked alongside the property industry previously at Genworth, and have a fairly good appreciation of a lot of what Rich has just shared. Today, I will introduce you to OFX, give you a bit of insight on who we are. I will give you an understanding of what drives FX rates and what those key factors are, just to be aware of if you are looking at purchasing as an international investor, for example. And lastly, I'll share with you some of the OFX tools and support that's available to you so that you can make sure you do have the right strategies in place and that you're also able to reach the right people at the time that you need them most. So firstly, just a flavour of OFX and who we are. We're a specialist money services provider, international money services provider. We're based in Sydney, that's our head office, and we're listed on the ASX. We do have offices around the world, as you can see from the map in the centre, in Sydney, Auckland, Singapore, Hong Kong, North America and Europe. Having those international bases is a real advantage from our perspective for two reasons. One is it gives you access to 24/7 support as we move with the sun, but also it gives us the knowledge of those particular markets and what to expect and how to help our customers best. We serve both consumer and business clients, and we have a human plus digital business focus. So what does that mean? It means that you've got access to people when you need them, but at the same time, you've got access to managing your transfers independently online. If you've got that confidence and experience to do so, you can do that anytime, 24/7, and again, gives you a lot of flexibility. Just to touch on some of the products that we have that will be of interest. Predominantly, we deal with spot transfers. What does that mean? It means you book in today's rate, you book your deal, you make the move, and pay now. In a lot of instances, and you'll see in some of the examples I walk through shortly, things like a forward exchange contract actually becomes really relevant, particularly in the property market when you're looking at settlement that's potentially 6 months out from when you purchase. We can also do limit orders, which enables you to set a particular rate that you're targeting and move money at that time when that limit is hit. On the right-hand side of the screen, you'll see we have global currency accounts. This is predominantly for businesses who are transacting or working in multiple currencies and countries, and it gives them the flexibility to receive in local dollar and be able to move that money around the world as needed with their different global currency accounts that they hold with us. So I'm going to spend a bit of time just talking to you about what drives FX rates, hopefully give you an understanding of some of the fundamentals. Apologies if I touch on things that are too fundamental, but it does give us a good balance to start with. Okay, so first of all, I just want to call out on the bottom left-hand side there's a really interesting fact that when I started at OFX, I did not appreciate. FX markets is the largest financial market in the world. The daily volume traded is $6.6 trillion. It's quite extraordinary when you think about it. And it does also give context then why, when we look at some of the key factors that are driving the FX market, what does and what in particular, what doesn't impact it. So if you look at what does drive the market, at a basic level, it's supply and demand. You can see on the right there, I've given a basic illustration that shows that when the demand increases for the AUD in relation to USD, for example, the exchange rate will improve. That is, you'll get more USD for every AUD dollar spent. From a macro perspective, the fluctuations in the exchange rate will have an effect. So for example, if there's a stronger AUD, imports will become cheaper, which means Australian importers can buy more product with the same Australian dollars that they've got available. Similarly, Australians will increase their global investment. Overseas investment, such as property and shares, will increase as the AUD gives Australians more buying power. On the flip side, when there's a weaker AUD, exports will become cheaper. And in Australia, our main exports are things like iron ore, petroleum, gas, and gold, and we will see an uptick in demand. We'll also see greater international investment. So global investors will have a greater demand for Australian investment, whether that be individuals, such as potentially some of yourselves who are looking to purchase property, or international hedge funds who are purchasing government bonds. We'll just see that increase in demand. So hopefully this gives you a foundational understanding of what global events will generally affect the FX market. We have a look at things like currency swings. This is, for me, one of the most critical things to be aware of, because the impact, particularly when you're moving large sums of money, can be quite dramatic. So on the upside, if you look at the top graph, for example, if the currency you wish to buy falls relative to the currency you own, your cost will fall and your profitability will increase. But on the flip side, if the currency you wish to buy strengthens relative to the currency you own, your cost will increase, meaning your profit will decrease. So you can see two examples provided here on the right-hand side, which I'll just talk through for a moment. So in the first instance, if you're paying 100,000 USD for a USD invoice, based on the currency forecast, and this is based back last year in Q2 22, it's a good time to have a look at the swings. The difference between the highest and the lowest rates could have actually cost you almost $14,000 AUD. That's quite a significant amount when you're looking at the amount that you're looking to pay. Similarly, in the second example, if you were paying a £100,000 invoice in Q2, but your settlement wasn't until Q3 in 2022, based on the forecast at the time, the difference between the highest and lowest rates also could have cost you in that vicinity of 14,500 AUD. So you look at that as when we talk percentages, 14%, that's quite a dramatic amount of swing that you could experience in what you would be paying, either gaining or losing, depending on when you pay. So I'm just going to share another example, which is probably quite relevant to the audience here today, particularly when you are looking at property from an international property purchasing perspective. So if you decided, and I've used a USD AUD example because last year there was such a huge fluctuation as we saw through the market from the beginning of the year through to December, and even now today with the AUD picking back up, that it was a really relevant example to share to show the true impact of what could happen depending on how you purchase and when you purchase. So if you decided to buy a house in the US and you need to move money sometime in the next few months before settlement, this graph actually shows you the impact that timing can have on that. You can see in the graph that the difference of exchanging on the 5th of April versus the 26th of April in 2022, a mere 3 weeks, would have cost you almost $90,000 AUD. That's quite a significant amount. I mean, we're talking about a $1 million investment, but at the same time, that's a significant portion of what you would be paying. That had you paid 3 weeks earlier, you would have got a much better return on it. So like we at OFX, I think, Rich, you used the term, and I wrote it down, everyone has an opinion earlier in your presentation. And I really like that because everyone does have an opinion. Look at OFX, we're like everyone else. We don't know the future, we can't predict it. But what we do find is that history does often repeat itself. And we do keep a really close eye on the trends of market, both immediate and longer term. So in this example that I'm showing on screen here, a number of my colleagues and I, at the time, when we were starting to see the swing from the Australian dollar, we actually reached out to many of our clients just to advise them that the AUD USD rate at this point here in April 5 was actually at one of its highest historically, and it was a really good time to move money. Knowing what we know now, we saw some major changes in the rate that dropped off obviously right through May and the remainder of the year, which thankfully at this time when we made those calls to clients, a lot of those clients acted on that and did move money. I'm going to share one more case study with you again, which I think is highly relevant. And this starts to bring in to the picture how OFX can work with our clients to determine the right strategies when you are, in this case, investing and buying a property. We work with a lot of clients to understand their need. It can be something as simple as I need to move money to my family overseas, or it could be something more complex, such as I'm buying a property, settlement's not for 6 months, I need to manage that, and I'm unsure what the market's doing. As I said, OFX spends a lot of time keeping a close eye on the market. We do a lot of trend and analysis, and we do try to provide that insight and that expertise to our clients to help them make good decisions when they are looking to book in their transfers. So in this example, we've got Chris. He's a consumer and he's purchased a house in the UK in 2021. He purchased the house for £400,000. The deposit of £80,000 was due up front in March 2021, and the settlement for the balance of the house was due in September. So that 6-month period was quite a period of time that anything can happen. We helped our client pay out the initial deposit up front at a spot price of 0.56. And at the time, we booked in a forward contract for this client for the remainder of the balance at a rate of 0.556. What we saw in September was the rate had dropped to 0.5307. So having the forward contract in place did give this client protection from the downside and saved him $27,000 AUD. Again, a good example of how working with our team, giving them an understanding of what you're trying to achieve, what your circumstances are really helps them be able to give you the expertise and direction that can give you the outcome that you're desiring. So then what kind of things, aside from understanding supply and demand, might actually impact the FX rate? On this slide here, I'll just give you a bit of insight into some of those key drivers that we look at and we keep a really close eye on. If you look at the left-hand side, we've got things like the RBA cash rate decision. This is one of the core ones for us. And Rich, you've given us a bit of flavour around inflation and the interest rates and the impacts that has in the property market. It's the same in the FX market as well. So when interest rates and inflation do change, it does impact the way the global investors will look at their funds under management. So every money manager makes a simple risk-reward calculation, and fundamentally what drives the move of those currencies is investors will find AUD investments more appetising as the interest rates improve. The market then is aware that more investors want the AUD when the rates improve. So what you'll find is that the likelihood of a future rate rise increases will begin to have an effect on the currency long before the decision is actually made, which means that we're trying to anticipate the market and what's happening. But if we look at 2022, there was an anomaly. Back in May and June last year, the RBA had some of their first rate rises, which were higher than expected. And this saw an immediate increase in the FX rate on the day of announcement, which is not always typical. This was because the market was surprised. It wasn't anticipating the degree of the increase, and as a result, we saw that uptick very quickly on the day that the announcement was made. The next one that I'm going to touch on is political uncertainty and corruption. So we see political uncertainty is a strong downward driver for currencies, as we've seen with the war in Ukraine. And I'll give you a bit of insight into what that has looked like over the last 12 months. So most people would understand that a large-scale war in Europe would affect FX rates. However, when asked, I would guess that many people would not understand why. So hopefully I can give you that understanding. Early in February 2022, so about a year ago from now, Putin began publicly threatening the invasion of Ukraine in ways that took the Western world by surprise. This was deeply concerning the global community and specifically the investors in Europe. So with the real potential of a land war and what may entail, investments in parts of Europe became higher risk and the demand for the euro began to dip against the AED. At the end of February, Russia began their invasion. This turbocharged the uncertainty and the fear of global investment in the region, and much investment fled the Eurozone region in a very short period of time, as investors couldn't accurately judge the risk of their investments. So to add to the exchange rate effects, at the end of February, much of the developed world also imposed various sanctions on Russian exports. Russia is the world's 5th largest exporter of iron ore. Australia is the biggest. So what impact did this have for us? When the developed world overnight stopped buying from Russia, they started looking for demand to fill that demand from Australia, which also then had a positive impact on the AUD. So you can see how things like RBA cash rate, the political uncertainty can have quite a significant effect on the FX market. If we look at the other side of the equation, what doesn't have an effect, giving you two really simple examples. Rich, you asked earlier about people traveling and whether that has an impact. I think when we were chatting before this started, yes, it can. We do a lot of business with people who are looking to travel and need funds, but also we do see a lot of people moving. Global mobility is a large sector of what we do every day. But for people moving internationally to have an effect on the FX rate, I use the example of New Zealanders. We saw last year a change in their rising unemployment rate, and we did see a large migration of New Zealanders coming to Australia. But unless we see most of New Zealand come in a 3-month period, it probably won't impact the FX rate. Similarly, we see a lot of people going on holidays to Japan, probably won't have the impact on an FX rate. So hopefully that gives you a bit of an understanding of the big drivers and the things that happen that we support, but don't necessarily drive the FX rate. So lastly, I'm just going to give a bit of an overview of some of the tools and support that OFX can provide you if you are looking to purchase property, invest, or move money just generally internationally. One of the key things that we look at, or take pride in is the fact that we're human plus digital. So we're real people, we provide real help 24/7. We have those offices around the world that I mentioned earlier, gives you access to OF experts 24/7. Our experienced dealers are here to work with you at any time, give you an understanding of what the potential options are for your move, how we can best support you to achieve your goals when you are moving money internationally. At the same time, we do have a digital first approach. We have a platform that you can access either via the web or via an app. And that gives you that flexibility and confidence to make the money transfers yourself. What I've got here is just a couple of key tools that we make available via our webpage. These are things that give you, if you're quite savvy and keen to keep on top of what's going on yourself, there's lots of materials, lots of information available via the OFX website. At the same time, we've built some tools that hopefully make it easier for you to get access to that. I know everybody's pretty busy. I know myself, I don't always get the chance to go and check all, what's been happening in the world. So I rely on things like our OFX daily commentary just to get an understanding of what's happened today. Great example. Today there was an uptick in the AUD, which is, good news for us if we're looking to travel or to buy, buy internationally. Not so great if you're looking to bring back, but that's okay. That's against the USD. But that daily commentary is really simple. You can sign up to it. It will give you a flavour of what's happening, keep you aware of some of the major movers that might be impacting the FX rate at the time. We also have a rate alert. This is a great tool to set up if you are looking to move money, whether that's for a property purchase or otherwise. You can go in, set up multiple rate alerts. It doesn't have to be, just one. You can set it up in the different currencies, and that will basically give you a notification that when that rate is hit, your rate's been hit. That gives you the ability to then go and move your money accordingly. And lastly, we do a global currency outlook once a month. It's a short newsletter that just gives you a flavour of some of the key events around the world that might be impacting, similar to what I've just talked through today in terms of those key drivers. I've provided down the bottom there the OF Expert contact line. We have a great customer support team that are always willing to help. As I said, it's 24/7 and gives you access to be able to answer your questions. And lastly, it's really easy to register. Provided here is a link which you'll get in the presentation when you receive it. It's a couple of steps just to put your details in. You hit register. You'll get a call from one of the OFX team just to confirm who you are, and then you're ready to go. It's a very simple process. So that's all I've got today, Rich. Hopefully, it's given people just a good understanding of what happens in the FX market, and I'm happy to take any questions as they come through.
Thanks so much, Natasha. I was particularly interested in one of your slides, just that forward contract, which I thought was brilliant. Just the level of protection you can offer a client and just the amount of savings. So yeah, it's just it's like getting insurance. So really, really good suggestion. Yeah. Yeah,
absolutely.
So
thanks, Rich.
go on.
No, I just said thanks, Rich.
No worries. If anyone's got any questions, I've got 2 questions here so far, but just in the Q&A box down the bottom of the screen there, just click on that, type in your question, and I'd love to answer anything you'd like to ask there. So firstly, Philip's asking, would you please comment on why there is a significant drop in listings? Tough question to answer, Philip, because it's sort of getting into the minds of would-be or potential vendors as to why they wouldn't list their property for sale. So I'm just speculating, but I'd suggest that they believe that the market's down, therefore they don't want to list their property in a down market. It might be that the timing is not right for them to move to their next property. But it's probably the main reason is simply they just don't feel they're going to achieve a premium price. The thing is, if anyone is out there looking at selling, you're also going to be potentially buying in the same market. So if you're selling for 10 or 15% less, you're going to be buying for 10 or 15% less. So there's really no difference in those relativities. People are still going to die. People are still going to be getting married. Still people are having babies and need more space. There's always reasons why people need to buy and sell, and they'll still continue throughout 2023. Another question from Benson. Would you help build a strategy based on my situation? The simple answer is absolutely yes. That's exactly what we do, Benson. We help look at each individual person's situation and look at what their objectives are, their goals, their borrowing capacity. We help build a team around you. and from there we execute that strategy. So yeah, please reach out, and we'd love to help you on that property journey. Someone's asking, how can I approach Australian property investment when there is a lot of red tape with overseas income? What are the tricks of the trade? Excellent question. And my previous webinars that I've done on that, we have connections with some excellent expat specific mortgage brokers, because the typical bank will wash off 30–40% of your income, and therefore your serviceability to buy Aussie property is dramatically reduced. So the trick is to use a broker that has the right connections with the right banks, and they can get you the right kind of loan. So it may not be with the majors, it might be with a second tier lender, or it might be going through a particular BDM at a bank to actually get that, and knowing how to package up your loan so it's going to be accepted by the lender. So there are definitely tricks of the trade, but we can certainly, if you give us your details, we can certainly refer you on to the right person to chat to get that borrowing capacity there. Craig's asking, given the market, I'm interested to hear about you're currently buying, targeting in regional areas, Newcastle, Geelong. Yeah, great question. I didn't put up many examples, but we're definitely buying Newcastle and those outer areas like in Melbourne, and also Sunshine Coast, Gold Coast. The whole, what we call exodus to lifestyle, Craig, has been an amazing uptick in those markets. A lot of people have moved there. Newcastle's going gangbusters. We're getting probably yields averaging around 4.5% in Newcastle, and we think that's going to continue. So Newcastle's the 7th largest city in Australia. Great beaches, close to the Hunter Valley, and there's really good demand for property there. So we think that market is a really good opportunity. Also, someone's asking, is it a great time to invest in Melbourne? What are some of the starting properties up to the $1 million mark? Yeah, look, the Melbourne market, we think hasn't really experienced as much of a downturn as what Sydney has experienced. Sydney, in some pockets, like on the northern beaches, it grew 40% during the boom and dropped back probably 20%. Melbourne's dropped back around between 6 and 8%. So we feel that, and a lot of migrants too, I should have mentioned this earlier, a lot of migrants that are coming into the country tend to end up in Melbourne. So we think that Melbourne has significant potential for capital growth. It doesn't have as high a yield, but if you've got the income and can hold the property, the capital growth in Melbourne, I think, will be very, very significant over the next couple of years. So up to $1 million, yeah, we can still buy a good 3 to 4 bedroom house, particularly in the Bayside suburbs, probably about 40 minutes out of Melbourne. That'll return, say you're buying for about 800,000 or 900,000, you'll get a rent of around $750 a week. So really, really simple kind of investment strategy there. Someone is also asking, what is Propertybuyer's approach to helping price the market for expats? So look, what we do for expats is just an extra level. So we, a bit like what OFX does in providing that coverage or insurance, we do the same thing for our expat buyers. We will set up a WhatsApp group. We can do a lot of virtual inspections for you. We have particular lawyers and finance brokers that can really help smooth out that whole process for our expat clients and really make it a seamless experience. Some of our clients obviously will fly back and have a look at the property before we buy and before we execute. Others are happy to buy sight unseen. But what we do as buying advocates is put ourselves in your shoes. We treat it as if it's our money that we're buying this property with, and make sure you get 100% looked after. Cassie's asking, which areas in Melbourne would you suggest? Very difficult question to answer, Cassie, unless we know your situation. I mean, it just depends on your budget, you know, whether you're an investor or a home buyer, as to what we're going to recommend. But we don't have one size fits all. We offer a very tailored solution for all of our clients, and that's how we work it. So based on your individual needs, it might be you're going to buy a unit at St Kilda or a house at Beaumaris or something in Carlton. Really, it just depends. There's one for you there, Natasha. How can OFX assist me set up an e-commerce art business?
Yeah, no worries. Look, OFX can help you with that in terms of our global currency account. I touched on it in terms of one of the products we've got. It's designed for a lot of e-commerce businesses. It gives you that access to set up your accounts in the different locations and be able to receive locally, pay out locally. We partner with a lot of different payment gateways as well, and you know, the likes of Amazon and so forth. I'm more than happy to take that one and speak to you directly, and we can see how we can set that up. I can see there's another question here. It looks like OFX is really easy. Do banks like OFX, or are you basically competing for customers? Look, I like to believe OFX is really easy, particularly, you know, for both registration and actually being able to book in your transfers. In terms of the, you know, do banks like OFX? I'm not sure where that question is actually coming from, but to give you context, we work with a lot of international banks, some of the biggest ones, in terms of moving that money to ensure that it is, you know, the fastest transfer, good pricing. We don't have any fees attached to it, unlike some of the banking partners that you might deal with currently. And we do look at competitive rates or margins when you look at your FX rates. I think in terms of that, you know, we're not the cheapest in the market. I'll be really honest with you. There are some out there that will give it to you almost for free. But what we do come with is the security and the confidence and that support that I talk through in terms of enabling you to reach out to people. So again, more than happy to have a chat and give you a bit more information if interested.
Right. And there's another question here. Any opportunities in Brisbane and Gold Coast? The very simple answer for that, Anne, is a resounding yes. There's some excellent opportunities in Brisbane. I mean, that market really is going to continue to be strong. Same with the Gold Coast. There was, over the last 2.5 years, 50,000 people have moved from Sydney, Melbourne and other parts of Australia to the southeast Queensland corner. So it's incredible, just the demand for property there. The vacancy rate in Brisbane is 0.7%. So trying to rent a property in Brisbane, you've got to line up for one. I've just bought in Brisbane last year myself, and I've owned properties on the Gold Coast too, and there's some beautiful pockets there to buy. So, and it's quite a lot more affordable than Sydney and Melbourne. You know, as you saw in those initial figures I put up for the median house prices. So you can buy a good quality investment property in Brisbane, you know, a really nice 4-bedroom house for about 750, 800,000, and you'll probably get $750, $800 a week rent for that. Similarly, on the Gold Coast, you can buy good quality apartments, you can buy on canals, you can buy mansions. There's, again, your whole, depending on your budget, you know, we'll tailor something to fit. But the yields are definitely very strong in that Brisbane market as we're going forward. Another one for you there, Natasha.
Yep. In terms of tax implications, moving money from the UK to Oz via OFX, look, this is probably actually one for your accountant. There would be undoubtedly some kind of tax implications. When using OFX, it's no different than if you were to use your bank in terms of impact on things like your tax. You're just more likely to get a better return when you actually move that money across. If you're subject to other tax implications, you know, based on what you're moving money for, then that would still be relevant at that time.
Brilliant. Very good. Well, we'll be sending out a copy of the presentation, as I mentioned, to everybody. Unless there's any more questions, I'm going to wrap it up today. But I just want to say thank you very much, everybody, for attending. Really appreciate your participation and hope you got some great value for it. And yeah, look forward to seeing you on future webinars. And a special thank you, Natasha, for...
thanks for having me today, Rich. It's been great.
Yeah, it's great. So thank you, everyone. Have a wonderful Wednesday, and we'll hope to see you again soon. Bye for now.
Thanks.